Good morning. We will pay attention to the theory of companies today, and we will start with shareholders' equity. Shareholders' equity is the amount of money that the owners put into the business that belongs to the shareholders. So the shareholders is the owners of the company, and when the company wants to sell shares, they will register a certain amount of shares that they think they will need in the future to obtain enough capital. So it means this is the maximum number of shares that they can issue. That is my authorized share capital. This is never used in any calculations to determine the share capital or to determine dividends. It is only recorded in the note for share capital that will accompany the balance sheet. So authorized share capital, never use it for calculations. The issued share capital is the actual number of shares that was already issued. So the company might say that they will register and have authorization of 1 million shares. But at the beginning, for instance, they only need, say, 200,000. So they issue shares for 200,000. And that part is then the issued share capital. That is their share of this total capital. And the number of shares will depend on how many they issue here. If, for instance, a year later they need money again, then they can issue more shares to obtain the capital they want, and then all that are still the unissued shares that hasn't been issued. Okay. The issued share capital is used to determine the value of your shares, the total capital amount, and we use this to calculate the dividends that will be paid to the shareholders. Dividends is the part of the profit that is divided between the shareholders according to the number of shares that they have in the company. Retained income is the amount of the profit that was not distributed to the shareholders. So at the annual meeting, they can decide to retain some of the profits so that in future they can expand or to provide for a bad economic year in the future. So retained income forms part of your equity. So share capital, the issued share capital, and the retained income is your total shareholders' equity. So we know that equity always have a credit balance. So issued share capital will have a credit balance and retained income will have a credit balance. When we do an exercise, you must always determine the financial year because all these calculations must now be done for that specific year. And they say here the end of the financial year is 2024, so this financial year will go from the 1st of March 2023 to the 28th of February 2024. Okay, the first entry that we will record is the retained income balance at the end of the previous year. So in retained income, we will indicate that on March the 1st, there was a balance, so some of the profits were kept back in the business at the end of the previous year. And they say the total amount for retained income was 48,900. Okay, we will also have to indicate what is the balance of the ordinary share capital. Now, to determine this balance, we will have to do a calculation because various shares were issued in the past. So the first one, they say on 1 March 2021, so it's long before our year, 200,000 was issued at R2.50, and that gave me 500,000 rand. And then on September 22, again before our current financial year, 200,000 was issued at R2.80, and that gave me 560 Rand. So if I add that, my total capital at the beginning of the year that was already issued in previous years is that 1060. You can also show the calculation here in brackets or just above the ledger account, because this will count 4 marks to ensure that you get all your marks or part of the marks if you made a calculation mistake. Okay, now on 1 June 2023, 200,000 shares were issued at R3. Okay, so we sell another 200,000 times 3 gives me 600,000 Rand. This is now in our current financial year because it's 1st of June and it's in that current year. And my total capital will now increase to 1.66 million. Okay, so here I'm going to show the date that we issued these shares. So it's June the 1st. The ordinary share capital increased with 600,000. So that means my total capital is the two added together to give us the total amount of all the share capital that they have in this business. If you have to do this entry for the issue of shares in the general journal, you will indicate that the bank is debited because we receive money and we credit the ordinary share capital account to increase equity. Then the business decides to repurchase 100,000 ordinary shares at R3 each per share. Okay, so that means we are prepared to pay them back more than they originally paid for the shares. So we have to determine what is the average price. So the bank, the amount that we will take out of the bank is that 100,000 shares that we want to repurchase at R3. So the bank will be reduced with 300,000. Then I will take my total capital that we calculated and I will divide it by the 600,000, and that will give me my average price per share. So because the shares were issued at a lower price in previous years, the average will be lower than the R3 that we are paying. So what we will take out of the capital account is only the amount that we originally put into the account. So when I put the amounts in the capital account, I showed it at the amount at which we sold it. So we can't take more out on the debit side than what we put into the credit side. The rest of the amount will be taken out of retained income. So the 100,000, R3, 277 is the average price. So what we will take out of retained income is 23 cents, and that will give me 23,000. So I will indicate in my capital account on February the 27th that we reduce our share capital with 277,000. So that's the 100,000 times the average price of 277. Then the rest of the amount will be taken out of the retained income. So February the 27th, bank 23,000. And these two amounts must add up to the total amount of 300,000 that we have to pay out to the shareholders. So what is very important is that we can only take out the average price out of ordinary share capital. The reason why we will pay money out of retained income is equity consists of capital and retained income. So the people who bought shares in previous years are entitled to part of this profit that was not paid out to them. And that's why we will pay it out of retained income. Okay, then dividends on ordinary shares. Okay, the dividends that we pay on ordinary shares is the total amount dividend that was declared at the annual meeting, and you will multiply it with the number of shares. So the profit of the company is distributed to the shareholders in the form of dividends. So if I have 1,000 shares and they pay me 5 cents per share, then I will multiply 1,000 with 5 cents, and that's the amount that I will get. If someone else has 2 million shares, then you will multiply 2 million with the dividend to determine. So the more shares you have, the more profit you will get out of the company. The shareholders registered in the books on the date that the dividends are declared is entitled to the interim and final dividend. So if they don't have shares registered in their name, or they are not in possession of shares, even if a dividend is declared, they will not receive a dividend. They will only get a dividend if the books indicate that they are registered on that date and that they have the shares in their possession. So if I want to do the dividends, I will debit the ordinary share dividends because this is an expense that will increase on the debit side. And I will credit the shareholders to indicate that we owe money to them, so the shareholders is a liability. We write shareholders, that is my creditors. Why are we owing money to them? For dividends. So it means we owe money to the owners for dividends, so that gives me the liability. You get confused with these words, so make sure that you understand which one is the expense and which one is the liability. Ordinary shares is the shares that the owners bought in this company, and because they are shareholders, they are entitled to dividends. So the dividends is the expense that's paid out. When the money is paid, the shareholders will be debited to indicate that you don't owe that money anymore. So when you declare the dividend, you create a liability that increases. When the dividend is paid, you decrease that liability. Okay, on the 1st of September, an interim dividend of 15 cents per share is declared and paid. Okay, that's on the 1st of September. On the 1st of September, ordinary shares were issued at R2.80 per share. How many shares do we have on the 1st of September? 200,000, 200,000, 200,000, so it's 600,000 shares. So I will indicate that on the 1st of September, there are 600,000 shares in issue. They pay out 15 cents, so that gives you 90,000 rand. So the ordinary share dividend is your expense for the business that will be paid out of the profits. So I will indicate on September the 1st, we owe the money to the shareholders when it's declared. So we will indicate that shareholders for dividends will be credited with the 90,000, so we increase our expense on the debit side and we increase our liability on the credit side. Here we will show ordinary share dividend to indicate that the ordinary share dividend account was debited. And the interim dividend is always declared and paid. So the whole purpose of the interim dividend is to give the shareholders money twice a year, that they don't only have an income once a year. So interim dividends are always paid immediately. So I will indicate that I decrease this liability and that I pay the money in the middle of the year when I declare this interim dividend. Okay, on the 28th of February, a final dividend was declared. Now, if we look at the repurchase of shares, that happened on the 27th. So it means those people don't have shares anymore because we paid them back. So on the 28th, we will not have 600 shares anymore. We will only have 500,000 shares because there was a repurchase of 100,000. And you will multiply that with 25 cents. If they want you to calculate dividend, the final dividend on the shares repurchase, it must be written in the sentence to indicate that was the agreement that was made with these people. Okay, so we will debit our expense account on February the 28th and indicate that the shareholders for dividends will be credited with 125,000. So I've increased my expense, and shareholders for dividend will be credited on February the 28th, and we will indicate that the account debited was ordinary share dividends, 125,000. Now, normally this final dividend will not be paid because there's not enough time to pay it before you close your financial statements. So the closing balance in your shareholders for dividends will always have a credit balance to indicate that it's a liability that will be recorded in the balance sheet under current liabilities. So this closing balance in the shareholders for dividends will always be the same as the final dividends because the interim dividend is paid immediately. So if they don't tell you what is the dividends declared on the final, but they give you the balance as 125, then you know that it's 125,000 rand. Okay, the ordinary share dividend account must be closed off to the appropriation account because that is how the profit is divided between the shareholders, and it will be indicated as a current liability in your balance sheet. Okay, if we do the income tax, the rate currently in South Africa is 28% on the net profit that must be paid to SARS. This figure can change any time when they decide in a parliament that they want to change this 28%. Okay, the first provisional tax payment was paid on the 1st of September. Now, what happens with tax is SARS doesn't want to get money just once a year. So in the middle of the year, you take your income and expenses subtracted from each other, determine more or less what is the profit at that time, and pay 28% to SARS. And that is your provisional tax payment. Then in the middle of the year, you do the same. You determine more or less what is the profit and send them 28%. Then you finalize your accounts. You do all the adjustments, and as soon as the auditors are satisfied that everything is correct in your financial statements, you will for the first time determine the actual expense for the year. So it means you are never allowed to write in this income tax account until the last final profit was calculated at the end of the year. The provisional tax payments will go to SARS to indicate that we pay part of the debt that we owe SARS. Okay, so they say in this exercise that you pay provisional tax of 90,000. So in the SARS income tax account, you will show that we've paid out money on September the 1st in the middle of the year. So the bank account was credited and we paid provisional tax on the total debt that we will have at the end of the year. Then the second provisional tax payment is on the 28th of February, and that's 92,000. So again, no entry in the income tax account. We indicate that we are paying this liability to SARS, and we pay 92,000. Okay, so it means the SARS account is debited and bank is credited. Okay, now after this, we will finalize our financial statements. And as soon as we know what is the actual profit, we can only calculate the income tax. So in this case, say the net profit for the financial year that was calculated and that was submitted to SARS was 660,000. So on that 660,000, you will calculate 28%. Now for the first time, I know the actual income tax, the expense. So I can debit my income tax account and create the expense to indicate that part of the profits will be used to pay this tax. And on February the 28th, we will credit SARS income tax. And now we know what is the total amount that we owe SARS. So this amount that they calculated is 184,800. Then I can balance this account to see if I pay too much provisional tax or too little. So in this case, the balance will be on the debit side because the credit side is more than the debit side. So I take the credit side, subtract the debit side, and it indicates that I still owe 2,800 to SARS. And this is the balance that I will record in my balance sheet under current liabilities. Okay, what is very important with this SARS income tax account, except for bank, this is the only liability asset or liability account that you have that can sometimes be a liability and sometimes an asset. So in bank, if you have a debit balance, it means you've got money in the bank, then it's an asset. If you have a balance on the credit side, it is an overdraft, then you have a liability. In SARS, if we have a credit balance, it means that we didn't pay enough, and this figure will be shown in current liabilities because we still owe money to SARS. So, for instance, this balance came down on the debit side. Then you would show this as a current asset, because then you paid more provisional tax than the actual tax that you had to pay to SARS. So with a SARS account, you will never know whether it's a current asset or a current liability before you've recorded all your different entries. Now if we finalize the income statement, so we've done a trading account where we showed the sales, less cost of sales gave me gross profit. In the profit and loss account, the other income minus the expenses gave me the net profit, And now I have to show in the appropriation account how I will divide that net profit in this company. So it means we will, in the appropriation account, show what do we have to do with this money that we made. So there was a profit of 660,000 that we transferred from the profit and loss account. Now the first thing that we have to pay is the ordinary share dividend. So it means I have to close this ordinary share dividend and indicate that the total amount is 215,000, and this is a nominal account. All nominal accounts are closed at the end of the year, and we will transfer this dividend to the appropriation account to indicate that of the profit we will use 215,000 as dividends. In my appropriation account on February the 28th, I will do the double entry, and I will indicate that of this profits we will take for the dividends 215,000. Okay, then we will also, for the income tax must be paid out of the profit. Income tax is also a nominal account, so we will credit it and transfer it to the appropriation account. 184,800, and I will show that out of this profits, some of the money will be used to pay income tax, 184,800. Then I just balance my account to see what is my total at the end of the year. Now remember, we had a retained income account at the beginning of the year. So that was the money that was left over at the end of the year. This money, some of it was used, 23,000, to buy back shares. So we will have to show that the retained, the amount in your, get that capital account. In the capital account, we've taken 277, and out of retained income we took 23,000. So it means that the money that's left over in the retained income account after we've done that entry was 25,900. So that 25,900 I will transfer to the appropriation account. And I will show that is more money that we've got available that we can use to divide between the partners. Okay, and then I will show what is my retained income at the end of the year after I've taken everything into account. So the retained income was decreased with 23,000. So the amount that's left over that I can take to the appropriation account is the difference between the two, and that gives you 48,900. Okay, so I will indicate here that the money that we transferred from the retained income account was 25,900. So if I want to work out what is the retained income at the end of the year, I will add the credit side, 685,900, and then I just take that total amount on the credit side, the 685,900, and I subtract the 215,000 and I subtract the 184,800. And that gives me a difference of 286,100. So that means that is what I've got left over at the end of the year after I've taken the profit and the opening retained income into account, and now I will transfer this 286,100 to my retained income account. Now, if this amount increases from the previous year to the current year, then it means that we took more money to the retained income, and if it decreases, we use some of the old money. Now, the previous year it was just 48,900. Now it's 286,100. So a big portion of the profit was kept back in the business as retained income that was not paid out to the shareholders. Okay, we will pay a little bit more attention to buyback of shares, because this is a part where quite often you don't know how to do the calculation. So if they decide to buy back shares, it means that they're going to reduce their share capital, and they can either do it by just buying it at the price that the people paid, or they can do it at the average price, or they can do it at a higher price. Now, in this exercise, they say on July, the company decided to buy back 100,000 shares at a price of 3 rand. Okay, so if we look at our ordinary share capital account, we, for instance, had shares, a balance of 200,000 times 3 gives me 600,000 rand. And for instance, on April the 1st, we issued more shares, and we issued 300,000 times 3, and that will give me 900,000. So my total capital at this stage is 1.5 million. We are going to buy back 100,000 at 3 rand. So it's at the price that we originally issued it. So I will show on June the 1st that I will decrease my ordinary share capital with the 100,000 shares times the original price that I sold it off, and we will decrease our share capital with 300,000. If we decide to do it at the average price, we still have the same number of shares. So at the beginning of the year, it's the 200,000. That gives me 600. And on April the 1st, the money that we received for 300 shares was 900,000. Now, because they want to pay back at average price, it means that I take my amount of money that we've got, 1.8, we divide it by the number of shares, and that will give us the price, that the average price that we have to pay back. So I will debit on June the 1st, bank 100,000 times 3 rand 60, and that will give me 360,000. Okay, for the average price, we issued 200,000 times 3 rand, and then we issued 300,000 times 4 rand, and that gave me 1.2 million. So the total amount is 1.8 million rand. The number of shares that we've got is 500,000. So that gave us an average price of R3.60. Then they can also decide to buy back the shares at a higher price than the amount that the shareholders paid. So, for instance, we will have a balance here on July the 1st of 200,000 times with 3, and that gives you 600,000 rand. And then April the 1st, we issued more shares, 300,000 times 4 rand gives me 1.2 million. And now we want to buy back 100,000 shares at 4 rand. Okay, we can't take more out of capital account than what we originally put in. So as soon as you buy back shares at a higher price than the average price, you have to calculate the average price. So we will buy back 100,000 times 4, so the amount that will appear in the bank will be 400,000. Then I will take that 1.8 million rand and I will divide it by the number of shares, 500,000, and that will give me an average price of R3.60. So what I can take out of my ordinary share capital account is 100,000 times R3.60, and that is the amount that will go to capital. So I will debit my capital account on June the 1st and indicate that capital is decreased with 360,000. Okay. So if I subtract the 360 from the 400, there's 40,000 left over. So I will say 4 rand. The capital, we will take out the average price of R3.60. So I will multiply 100,000 times 40 cents, and that would give me 40,000 rand. So I will take to my retained income account 40,000, June the 1st, and indicate that I decrease my retained income with the amount that's higher than the average price. They will give you this information about the ordinary share capital that was already issued, and they will give you the amount for the retained income, the balance at the beginning of the year, that was 48,900. So of that 48,900, we've used up 40,000 now, so we can only take 8,900 to the appropriation account to indicate that is money that we still have left over to use in the future. I hope you understand this basic explanation of all the concepts in companies. It's very important to know what is the meaning of all these words, otherwise you will not be able to do it. Good luck for the exams.